QuickBooks Pro Plus Desktop 2022 Vendor section. Get ready because we bookkeeping pros are moving up the hilltop with QuickBooks Pro Desktop 2022. Here we are in our QuickBooks sample rock castle construction file. We have the open windows list open, which you can open by going to the view drop down and then go into the open windows lists. There's nothing currently in the open windows on the left, and also you can see that with the gray area on the right. Note that I've also minimized this little tab so that we have a little bit more real estate, a little bit more space in the open windows, which we may need. I'm going to be opening up the home page and then our two financial reports, that being the balance sheet and the income statement. To do so, we'll go to the company dropdown, open up the home page. It may not open up full screen here, so then I'm going to make it full screen, selecting this item, maximizing it in that gray area. Then we'll open the balance sheet and the income statement or profit and loss reports by going to the reports dropdown, company and financial. I'm going to open up the balance sheet first, which is way down here. Balance sheet standard report. And so we got the date as of 12/15/23. We'll talk more about the balance sheet later, but it's one of the major two reports, the other being the income statement or P&L, profit and loss. Opening it up, reports drop down, company and financial, profit and loss standard report. I'm going to start it off in January 1/1/23 to 12/15, tabbing over or refresh to get the most current data. So note that every time we enter a transaction into the system, it'll typically have some impact on the financial statements, major financial statements, that being the balance sheet and the income statements. All other forms, all other reports, I should say, then are going to be usually supplemental to the primary financial statement reports, that being the balance sheet and the income statement. So whenever we do any data input or analyze any form, you really want to be thinking what's going to be the import or the impact on the end result, that being the financial statements, balance sheet, income statement. Going to go to the home tab on the left-hand side, that opening up the home page. As we saw in prior presentations, this is breaking out and giving us a nice visual flowchart between the cycles that will be involved, one being the vendor cycle, the customer cycle, the employees cycle. We're focusing here on the vendor cycle. If you work at a larger type of company, then you're going to specialize most likely in one of these areas, either working in the vendor or accounts payable or purchases area, or the customers or accounts receivable, it might be called, or sales area, or the employee area or payroll, as it might be called. So if you work at a small type of company or your own company, you're more likely to do things, if not everything, in all the different areas, as we'll basically be looking at here. But it's useful either way to think about it in terms of the cycles that will be involved, and the flowchart is quite useful to do that. So note we have some terminology issues that you want to understand as well. Vendor means someone that sells someone, in essence, a market kind of situation. You might think of ourselves as a vendor, but in terms of QuickBooks, we got to say which side of the line, which side of the table are we on with the terminology they are using. When you hear vendor from QuickBooks, it means the people that we pay. We're buying goods and services from somebody else. When you hear the word customer, we as a business sometimes are customers. We're our vendors' customers. But from QuickBooks standpoint, a customer to us is our customer. That's someone that's going to ultimately be paying us for whatever goods and services that we provide for them. So getting these directionality between these terminologies is important. And vendors, in essence, means who we're purchasing from. The things that we might purchase would include things like the normal type of stuff that we would purchase under any business and as an individual as well, generally the end of the month bills, utilities, telephone, and so on. And then we also have things that we might purchase if we buy inventory, which could be a little bit more complex. So if we deal with inventory, then we got to decide, do we want to track the inventory in the QuickBooks system? If we do, that's when you got this added flow up top. If we don't have any inventory, then we will not have this added line up top. We will simply have the bills and the pay bills. You can also think of the checks, which is basically a decrease directly to the checking account, which could include like an electronic transfer down here in the banking as part of the vendor section. They put it in the banking because there's some crossover between money that's going out that might be going to a vendor. Most of the time, it most likely would be. And money that might be going someplace else, like paying off a loan, you might not think of as a vendor in essence, or if it's paying yourself as the owner. Now, to set up this top part, which we will do in the second half of the course, let's just take a look at it now, though that's where the preferences come into play. And the edits drop-down, preferences, if we were to go into the items and inventory section, left-hand side, and company preferences up top, checking these items off are what's going to give us that added line up top in terms of the vendor section. Closing that out, so that's going to deal with the inventory. If you don't have inventory, you're dealing with these items down below. Let's think about the vendor cycle from the easiest kind of standpoint and then build up basically in complexity. As we do so, we want to think about the transactions that are going to be happening on a day-to-day basis. More transactions that happen on a day-to-day basis, that means that they're going to try to make a form for it here, meaning the enter bills is a form, the pay bills is a form, and the checks, or these can also be used for payments that are going out, whether they be transfers or actual physical checks, will be basically a form. The forms do not mean necessarily that we're going to be printing the forms and giving them to someone else. We could in some of them, however, they're going to be the tools that we're going to use to make the data input as easy as possible, and they're going to be the things that are going to drive the transactions to the statements, which are going to be the major financial statements, the reports, profit and loss, and the balance sheet report. So whenever you enter a form, you want to be thinking in your mind what will be the impact on the profit and loss and the balance sheet, the major financial statement reports, and then secondarily on other supporting reports, which we'll talk more about in future presentations. So I'm going to close this icon on the left-hand side so we can see the vendor section with a little bit more space here. And the easiest thing that we would have on the vendor section would be a cash flow, not only a cash flow, but dependent on the bank, which isn't really a full service accounting system, but it's something that could be easier to do in certain circumstances. That would be easiest to do if we don't have inventory and we're not tracking our accounts payable, possibly in something like a gig work situation where we're basically paying for things as we go. And even then we're paying with electronic transfers as opposed to writing physical checks. In that instance, we might even rely simply on the bank, waiting till the transactions clear the bank due to the fact that electronic transfers clear the bank pretty quickly, and then pull our information from the bank, possibly with the bank feeds, the bank then having more detailed information due to it being an electronic transfer, such as the vendor information that's in the detail, which we can then construct our reports from. That would be the easiest kind of thing. It's even a step away from a cash basis, even easier than a cash basis, because we're relying on the bank to get the information. The reason it's not really a full service accounting system is not simply because it's not an accrual system, but a cash system, but also because we're relying on the bank. And what we generally would do then in a full service system is we would be writing the checks on our side, or the transfers that are coming out of our system. We record them independent from the bank, and then we would use the bank to double check that the records have been made, and that's going to be a big internal control that increases our accuracy a lot. So we would then be entering the transactions on our side, using the bank feeds possibly to match up to our transactions, or getting the bank statement at the end of the month and just checking that our transactions are correct at the end of the month. That double check, that's a huge internal control. It may or may not be something that would be worthwhile for you if you had a fairly basic system where most of your transfers are going to be electronic type of transfers. So then the next level up of difficulty would be, what if you had a system where you wanted to track your accounts payable, which is often the case. Oftentimes as small businesses grow, they get to the point where they get the bill. They're not going to be paying the bill as soon as they get it, but you want to get that bill into the system for multiple different reasons. One reason is once you get it into the system, then you can sort the bills by their due date so that you can pay the bill basically as late as possible. Usually when we think about cash management strategies, it becomes more and more important as your business gets larger to try to pay the bills as late as possible, because you want to basically hold on to your cash in essence as long as possible. And that those timing differences could actually have a big impact when you're talking about large amounts of transactions. This is why for large companies, you could have people that spend a lot of time managing their payables for this reason, to give your cash management strategy. When you're a smaller company, if you've got the time, if you've got the cash flow to pay the bills, then you might be more on a cash basis, just basically paying the bills as you go and not doing as much sorting on the accounts payable. When we get to the accounts receivable, we'll have another kind of issue, similar kind of issue on the receivable side. So if you are entering the data into the QuickBooks system and want to sort the bills by due date and pay them as they become due, that will be very important there. Also, you might say, well, I could do a system where I just stack the bills up on my desk or have them in my computer, in my email address or something like that, and then I'll pay them later on. You could do that, but that's going to be a lot more time consuming than sorting them out in the QuickBooks system with the pay bills. And if you do that system, then you got kind of a time lag as to when you're actually reporting the expense in the system. Because when you enter the bill, if you were to say get the phone bill when you get the phone bill, that's closer to the point in time that you actually incurred the phone expenses from the phone usage. You'd like to get the bill into the system, recording that expense at that point in time, even though you're not going to pay it for, in essence, possibly like a month later. So that's another reason why you kind of want to get the bills in there at an earlier point in time. This is an accrual transaction to enter the bill. So when you enter the bill, that's going to increase an accounts payable account, a liability account, helping you to track the bills that are outstanding. And the other side will typically go to an expense account if we're talking about an expense related item, such as something like the phone bill or the utility bill or so on. And then, of course, we will pay the bill. When you go into this item, this is where it sorts you it helps you to sort out the bills that are outstanding. You could select the bills that need to be paid and then choose the option on how you're going to pay them, with a check, for example, and so on, and then pay the bill in that way. So that's going to be, and when you pay the bill, that's going to be decreasing the checking account, the money coming out of the checking account at that point in time if paying with a check. And the other side is going to be decreasing the payable account, representing that you owe someone money. And note, there's also going to have to be a subledger account in terms of who you owe the money to. So that's going to be the pay bills. Then you've got up top the inventory. So if you're dealing with inventory, you might have a purchase order. Now, the purchase order is only usually going to be there if you're a larger type of business. It's a little bit different than when you purchase something, say, online as an individual. If I was to purchase something, say, from Amazon online, I would have to pay for it before they ship it to me. But if I'm a large company and I'm purchasing something like from China or something, a manufactured goods or something like that, I might be able to send them a purchase order, which in essence is saying, I would like this amount of material or these inventory items to be sent to me. And at that point in time, you're not actually paying for them and you haven't received them. It's just a request. And then when you receive it, then you enter the bill at that time. So if that's the system you're using, you might have the purchase order that would be entered. This is an interesting form in that although we track it, it actually has no impact on the financial statement, something different than basically most any other form that we would generally be entering on a regular basis. And then we would receive the inventory, receiving the inventory with a bill. We can imagine then getting the inventory and then having the bill attached to it. And we can then record the inventory at that point in time. When we record the inventory, if we're tracking it in the QuickBooks system, we would record the increase in the inventory. And if we enter it with a bill, increase the accounts payable. We would also have a subledger we'd have to deal with regards to inventory to track the inventory. And then we can basically pay the inventory at a later point in time. We do need to deal with the sales tax as well. So sales tax and paying the sales tax might be an issue. The sales tax will typically be involved when we deal with the income side of things. We got to record the sales tax if it be applicable with the sales invoice or the received payment, which we'll talk about later. But we're tracking the sales tax as a payable, meaning we're going to track the sales tax we owe as we earn revenue. We're going to have to pay it periodically. And therefore, this sales tax, they're considering it up here in the vendor section because we're going to be paying it off periodically. So that's going to be the major flow that we'll take a look at in future presentations. We'll go into each of these forms one by one and look at the impact on the financial statements. We'll also take a look at the vendor center, which you'll get to by hitting the vendor item up top, which will give you another area to kind of track the people that you owe money to, or your vendors. In other words, you can also get there by going to the vendor dropdown and the vendor center here.